Folks, the world is turning right side up. I'm talking about the yield curve. For actually almost 27 months, it was inverted, and now we are uninverting. The TLDR, a recession is coming. Now, that's obviously a pretty bold statement, and unfortunately, I can't give you an exact time period because that type of stuff, to be able to predict it accurately time and time again, you're just not going to be able to do it. But what we do know is every single time that this has happened in the past, a recession has followed. The question mark here is just when. And I'm going to get into the odds, the stats, what's happening, and really what does this all mean and how can we play it and how can we possibly make money off of it. We are uninverting. The yield curve is quote unquote steepening, and that's no bueno for the market. As you can see on the screen right here, yes, we are uninverting, but what's kind of cool about the 10-year is the sway of it. Not necessarily the magnitude, but whether we're going up or down is actually very, very correlated with unemployment. It's a good showcase of what's going on with the labor market. So when it's very, very low, that's a super hot labor market. When it starts to pick up, that is very much correlated with unemployment picking up, which we've been covering those reports. Unemployment's picking up. So it's kind of interesting to see how this all interplays with the economy. But right now, we're at this point where we're almost back at zero, as in the 2 and the 10 years are pretty much at the exact same yield, i.e. we're at the zero. But most importantly, what do I mean when I'm saying, this is going to cause a recession? Well, historically, really going back in excess of 100 years, it always just has. So let me give you some dates. Do you guys know what happened in 08? The market crashed. Do you know what happened in May of 07? The yield curve uninverted. Do you guys remember what happened in 2001? Another crash. Do you know what happened in November of 2000? The yield curve uninverted. Do you guys know what happened in 1930? A little thing called the Great Depression, and the market had some of the most historic losses ever. Well, guess what uninverted in October of 1929? The yield curve. All of a sudden, when it starts to bend back up, when we see that in the world of yields, a couple months later, and it does divvy up, it does change a little bit, we see very, very, very bad things both in the stock market and the economy, because obviously those times are also associated with a recession. Now, with that being said, there are a couple of fake outs. So if you look in 06, 1998, and 1989, those all had, in right here on the screen, 1989, it uninverted, but it reinverted. And then when that came out, once again, that's when rates had to get cut. We went into a recession. That's the pink stuff on the screen right now. If you look in 06, it uninverted. It was like a whipsaw, a false signal. And then we know what happened in 2007, and once again uninverted, and then we went into a recession. So this is kind of, yes, there are some false signals, but generally, if the false signal happens, it just, the whole situation rehappens again very, very shortly, and then that's when the bottom really falls out. And other times it just falls out right away. So this is all associated with the recession, but also notice what's going on with the rates. So this is the Fed fund rate. Flat rate, they start to cut. Sometime later, market falls, recession happens. Flat rate, they start to cut, as in the Fed. Sometime later, the market falls, we go into a recession. Right here, we're at a flat rate. And if you've been paying attention to the news, you know we're about to start cutting rates in September. In fact, we might get a 50 bips rate cut when everyone is expecting a 25. So my point is do I know where this is going to go in the short term? No. But I can tell you, every time this situation has happened historically, it has not been good in the slightest. Some people are pointing out the stock market similarities of the Dow right now, 2024. We got this expanding pattern, microphone pattern, higher highs, lower lows. Then we explode all the way up. We went up about 500%. And everyone's saying, okay, big question mark. What comes next? Well, look at what happened in 1929. We higher highs, lower lows, expanding pattern. This is almost 100 years ago. We ripped 473%, went all the way up, and then absolutely vomited. So is this a guarantee of exactly how it's going to play out? No, but that's why in the market we say history doesn't repeat, but it often rhymes. Speaking of rhyming, the 2-year treasury yield is almost back below the 10 years, so that's why we're back at zero, close to reversing the inversion. So change in the S&P 500 before and after the treasury yield, quote unquote, uninvert. So this is all measured in months on the bottom. As you can see, 07 and 2000, down and down and down. And this is about 12 months later. This is not a very quick thing. This isn't like a 1 day 0 DTE trade. This is kind of, we're talking about what happens in the next year, what happens in the next 18 months. There's only one example of it ending up fine, 1998. But don't forget, 1998 was the one where I told you it was a fake out, because then we all know what happened a little bit later from just the dot-com bubble. So we know in 2000. So this one was even more delayed, but still the initial onset for the first 3 to 4 months, pretty negative. And then we had one example, but really if this kept drawing out, it would just end up coming back down again because of the dot-com bubble. The other one I want to point out is, remember how I said the yield curve, not necessarily the magnitude, but just the sway of it. As that goes up, it's commonly correlated with unemployment spiking. So historically, 2000, 2007, unfortunately, people are probably going to lose their job because this is how it's all played out before. And you might be thinking to yourself, okay, I get this, but generally, if you've done any studying of it, you know you need some sort of catalyst. Like something has to happen. And one of those is, okay, is the labor market actually getting weak? And is there something else brewing in the background? And unfortunately, the answer to that is yes. So just this morning, the ADP non-farm employment change came in. They were expecting 144,000 jobs. They were off by 30%. It came in at 99,000. So that's not so good. And in fact, it's historically bad. The US economy added a lower than expected 99,000 jobs in August, missing the forecast of, they were expecting 122, other people were expecting 144. This is the lowest monthly total since September of 2023. That follows a downward revision of July, which added 111 compared to what was reported at 122. So even the other ones from the previous months, they're saying,
we actually counted those wrong. Sorry about that. My bad, brother.
And they're actually giving us the quote unquote real numbers. Now, even though this number of 99 was bad, I wouldn't be surprised in the slightest if next month it's actually revised to be worse. The weak ADP payrolls report adds evidence of a slowing labor market. Calls for a 50 basis point cut later this month will grow stronger as cracks begin to emerge in the economy. So to help with this, the Fed is now under a lot of pressure. Unfortunately, this could be some very painful medicine. A supersized Fed rate cut this month could be quote unquote very dangerous for markets, according to some economists who, I don't know, has fancy schmancy pedigrees on his wall. But let me explain really what's going on. Shout out to public.com for sponsoring this portion of the video. If you're an options trader, planning on becoming one, or just generally interested in the markets, you're gonna wanna listen up. For those of you who don't know, public.com is my favorite place to trade options. If you're wondering why, the answer is simple. It's the most cost-effective place to trade options. In fact, you can earn a rebate on every options contract that you trade. That means that you get paid a rebate for each time you buy and each time you sell for each contract you're trading. I love it because it allows me to focus on my actual trading rather than the headache that is trading fees. Now, beyond options, public.com offers you an entire suite of tools. They offer exposure to stocks, options, bonds, crypto, and even have a high yield account that's currently sitting at 5.1%. With all of these offerings, no commission fees, and no per contract fees with options trading, I'm confident you'll enjoy public.com as much as I do. So if you want to check it out, go to public.com/MattKohrs or just click on the link in the description of the video. Thanks again to Public for partnering with us, the Goonie community. So as of now that we're getting more and more signs of a weakening labor market, people losing their jobs, not being able to find jobs, the odds of a 50 bips rate cut are increasing. We're going to find out on Wednesday, September 18th. Please mark your calendars. So right now we're sitting at 5.25%. There's about a 50-50 shot of, are we going to get a 25 bips rate cut or a 50 bips rate cut? Let's think about what that's going to do. This Fed fund rate, that is going to basically help with credit conditions. It's going to make money more accessible. Okay, you're not going to feel the impact of it right away, so it does help. But in the short term, what is it going to do? When you cut the Fed fund rate, that weakens the dollar. That's interesting because you've probably recently heard about this yen carry trade, where if this is going down, not so good, because we know a lot of people are going over to Japan. They're taking out a loan because the interest is very, very low. They're converting it back to the US dollar and they're getting bonds or they're putting it in the stock market. But basically, it's an arbitrage opportunity between the difference in the currencies. So we don't really know how much money is in this trade. And all of a sudden, if it goes south, an unknown amount of money might be at risk. And that was kind of the hot talk at the start of August of, as this is going down and down and down, the difference between the yen and the dollar, as it goes down, the gap, the arbitrage opportunity is getting closer and closer and closer, and the people who are doing it might be at legitimate risk. Well, in mid-August, we started to bounce and everyone quickly forgot about it. They're like, never mind, it's fine, whatever. The dollar's going to stay strong, the yen's going to stay weak, and there's nothing to worry about. Well, there might be something to worry about, because if we don't get a 25 bips and we in fact get a 50 bips rate cut, that's going to continue to weaken the dollar. But we're looking at a pairing. It's the USD versus the JPY. So this drops if the dollar drops, it drops if the yen goes up, and it really drops if the dollar drops and the yen simultaneously goes up. That would really cause this to go down. So we know the dollar is going to drop, and unfortunately, it might drop more than we really anticipate, but also the yen is going up. This was just last night. Japanese yen gains further as wages exceed expectation. This is coming out right after the BOJ Prime Minister, the Bank of Japan, the equivalent of our Fed, they have one as well, their central bank, saying, hey, we have to go up. We're in a deflationary economy. We have to raise our interest rates. So we know the yen's going up. We know the dollar's going down. We know that's going to put downward pressure on this, which that's not so good. And this is all happening right when this is starting to steepen. Can you see what's happening here? Can you put all this together? We're in a situation where it is steepening in the short term, not so good. It means unemployment spikes. I mean, just the stats on the uninversion itself is not good. So the question this time is there going to be a catalyst? It might be the yen carry trade. It might not be the yen carry trade. I have no idea, but it's something you have to be paying attention to. So in the short term, what's happening this day? What's happening this week? I don't know. Flip a coin. Go ask your cat. Your cat's going to be as accurate as anyone else. But what I can tell you in a multi-month time frame, what happening right now, when it's happened in the past, has not been good. Now, I'm not saying this in any form to be a doomsday negative Nancy. I just figure if you know about it, you have a better opportunity to not only protect yourself, but most likely make money off of it. So is this the time where I'm like, hey, I'm going to load up my retirement accounts, buy all these high-flying, high-growth tech plays? No, because I know at some point, maybe in a couple months, maybe more than a couple months, there's statistically a very high chance of being able to get some of my favorite equities on a dip. When people talk about this, they get mad because no one wants to be negative or bearish or anything like that. And I just don't agree with it. I think the best thing to do is just accurately know what's going on. So you could play it. I mean, it doesn't matter, bullish or bearish, whatever time frame you're in, it always comes back to the same thing. What is the current trend? What are the current catalysts? And are you protecting your risk? Are you just actually sticking to your trading plan? That never changes. This is just, it's the game. And sometimes there's different aspects of the game. We're on a different chapter. And this is just what's happening right now. So I hope with all this breakdown, we're all a little bit more on the same page. But I do want to let you know, the market is firing very serious bearish warning signals. So please be prepared. Please pay attention to this. And speaking of which, if you yourself want to track what's going on with the yield curve, you can always come to TradingView and you just type in US 10Y, then there's a minus sign in the top right. You click on that and then you subtract the US 02Y. So you're taking the 2-year yield away from the 10-year yield and you'll be able to track exactly where it's at. And I think everyone should, because if you see this spike up, there is a very, very, very high chance that unemployment is also spiking. And if unemployment is spiking, that's just not good for the economy. Now, this is, once again, just to be very, very clear on this, this is painful short-term medicine. What this does is, okay, eventually the market, the economy absorb this, things settle down, and then we're building out a better foundation to go on the next rip. So in the short term, it's very, very painful medicine, but it ends up being better for both the economy and the stock market in the medium and long term. So it's just more of the short term, the next handful of months, that things could get a little bit froggy.